So there we have it. The numbers coming in slightly lower than we saw in the December period, but above expectations, where expectations were for that inflation rate to come in at 18% on a year-on-year basis. To what extent is there some disappointment about?
Well, I don't think the disappointment is major because we've seen the key areas that makes the CPI move, that's food and energy, have also declined quite, I would say, substantially. So I don't think there's really disappointment because at 18.31, as long as there's a downward direction, then that I think is satisfactory, and that also signals that the tightening of the monetary policy is actually taking effect.
We'll be getting to the effectiveness of that monetary policy, tightening policy in just a bit. But let's just hone in on the numbers here. And I asked the question as to why, if there was disappointment about, because on a month-on-month basis, this consumer price index has risen 0.56%. All components in the consumer price basket from the data we've got have risen for the December period, except transport, that was down 1.47%, and communication down 0.2%. So there are quite a few factors that are still coming to bear in a negative way here, Steve.
Yes, you mentioned transport. Transport, the main reason why it didn't rise is because this is a time when fuel prices were adjusted downwards, and that infiltrated into the fares that commuters were paying. So then they got a saving on that. But the main reason why you find that month-on-month there was an increase is for the simple reason that, you see, Kenya doesn't necessarily have food security. So food is a key component of CPI. And with the factoring in imports, then of course there had to be a price movement upwards, though slightly lower than the previous month.
Where are your confidence levels sitting in terms of the accuracy of this data, Steve? On the 29th of January, so just this past weekend, we've had the IMF bringing to question the reliability of Kenya's inflation data, saying that the method could have an upward bias that exaggerates the changes in cost of goods. Where do your confidence levels sit when you look at these numbers coming through?
My confidence levels will be upwards of 90% for the simple reason that the same IMF previously complained about Kenya using an arithmetic mean mode of calculating inflation. But then we've since moved to the geometric mean method that they had recommended earlier. But still, they seem not to be comfortable with the mode. So I'm thinking that we've already met the requirements. So the method of calculation, I'm confident with it.
So some divergence in opinion that's about when it comes to the data being released over in Kenya. Let's take a look at the monetary policy of the central bank that you were highlighting a little earlier, because it's an easing back of inflation that we're seeing come through nevertheless, showing that the central bank's newly adopted tightening stance is taking effect and having an impact. What's your assessment of the rate of impact?
Well, it's a bit slow. It takes time to trickle down into the economy, but these are the kind of signal. You see, what the regulator is looking for is a signaling effect, not necessarily a substantial downward movement in terms of inflation, because at the end of the day, there's still some element of demand for the key basic commodities. So you can't expect inflation to drastically decline, but it's a good move either way. And I don't see MPC reducing the CBR rate. I think they'll still maintain it until such a time when we see substantial downward movement of inflation and at the same time a stable Kenya shilling.
Yeah, you talk about a maintaining of a rate. Has today's data possibly brought to the surface the possibility of seeing yet another hike coming to the fore, in that these numbers have come in worse than a market consensus, Steve?
I'm not seeing any hike. I'm not seeing any upward movement because, you see, currently the situation has been such that especially the credit being tightened, most companies and also consumers who are holding loans are really feeling squeezed in terms of their cost of funding. So if it were to go up further, it will really now bring the economy down to a halt. So no upward movement. They'll likely maintain it at the rate at which it is. They won't bring it down because then they will be signaling that they are comfortable with the kind of movements going on.
Aside from just a tighter monetary policy stance, we've got the bank actively in the market mopping up liquidity, and that to maintain support for the currency to ensure that inflation keeps heading down. The effectiveness of that, Steve, as you see it at this stage of the game, and the kind of impact it's had on the shilling over the recent past?
Well, the central bank has been quite active in the reverse repo market, and they've been picking up, mopping up liquidity, and that has really helped in terms of the Kenya shilling strengthening against the dollar. I mean, currently we're about 84 from highs of hundreds and 90. So I would say that they've been successful in that operation in terms of just propping up the Kenya shilling.
Together with that, of course, what the high interest rate environment has done is boost the appeal of Kenya as an investment destination amongst offshore investments, specifically into government securities, and it's made it harder to fund long dollar positions as well. Steve, what kind of offshore investor interest are you seeing right now?
Well, we are definitely seeing flows, especially in the money markets and also the general fixed income market. The equities markets have been a bit slow, but there's still also some active foreign participation, because of course then on the equities they get returns in two forms: one on the real return of the investment, but also on an appreciating local currency. Now, those have worked towards helping the shilling in terms of strengthening, increasing dollar supply and dollar inflows, in addition to the normal inflows from agriculture and tourism.
How does that appetite from the offshore investor community compare to what we're seeing on the local front? Because towards the end of last year, it was specifically the high inflationary environment that had come to bear on local investors and their lack of interest in investing and the markets overall.
If we take the example of the equities market, it's predominantly an institutional investor-based market. And what we've seen is that there's been more of foreign institutionals on the buy side than locals, for the simple reason that the local institutional investors have been getting attractive returns in the money market. So they've just been parking cash, either the banks or playing short-term treasury instruments, rather than getting into the equities market. Also, the issue of us headed into an election that increases some uncertainty.